In this session, we want to cover the intercommodity spreads. And the intercommodity spreads are the most volatile spreads of all three types that we've been discussing. And this is fairly obvious when you think about it, is this type of spread entails the simultaneous purchase of one commodity and delivery month, and the sale of another different but related commodity with the same or similar delivery month. These spreads are commonly done and can theoretically include any commodity against any other commodity. However, only a few of the combinations of intercommodity spreads are exchange recognized and receive a break in margins, and usually margins for spreads are lower. Here is a list. We're looking at a list on the screen of the more popular intermarket spreads by commodity group. Because you remember, an intercommodity spread involves buying a futures contract and selling a similar but different commodity.
Yeah, if you kind of go down the list here, it makes sense. They all fall within the same groupings that we have within the software. We look at the grains. We've got soybeans versus soybean meal. The relationship there is obvious. Soybeans versus soybean oil. You'll notice that a couple popular spreads that you've heard referred to a lot aren't on there, like the corn-wheat spread.
That's because that's not recognized by the exchanges anymore, right?
Right. That is no longer an exchange-recognized spread.
Why did they pull that off, incidentally?
Basically, you're looking at two commodities that are very different, related. They're both grains, yes, but corn is a feed grain. Wheat can be a feed grain, but is mainly used for milling into flour. Corn is planted in the spring. Wheat, at least winter wheat or board of trade wheat, is planted in the fall. That's why it's called winter wheat, or in the winter. Basically, the corn crop is pollinating when the wheat crop's being harvested. It's not that uncommon when you look at prices to see corn up 2 or 3 cents and wheat down 2 or 3 cents.
So they didn't want to recognize these anymore because basically of the volatility, which incidentally means that you don't get the margin break.
Right. That's the only thing it means, is you don't get the margin break. You pay full boat on both sides.
So then we got the livestock. So we're looking at pork bellies, lean hogs, live cattle, lean hogs.
Right. All those make sense. We're either looking at the beginning stages of production to the end stages of production, like the live cattle feeder cattle spread or feeder cattle live cattle spread. Or you're looking at two different types, two different areas of a slaughtered animal, as in lean hogs to pork bellies. Or you're looking at competing meats, live cattle beef versus lean hogs pork, live cattle beef versus pork bellies or bacon. Thin cows, those feeder cattle are eventually, bam, going to be a burger. Let's put some bacon on that burger. That kind of keeps them all together. They're all obviously related, maybe not terribly closely, but they are related. And, if we go down to the petroleum, where's heating oil come from?
Comes from crude oil.
Yeah, it's cracked out of the crude oil. Where's unleaded come from?
Comes from the crude oil.
Same place. Obviously, then,
natural gas is a byproduct of crude oil production.
Exactly, and obviously, then, unleaded gasoline is related to heating oil as well. They both come from the same place. Within the metals markets, we've got the gold-platinum spread, and that's the they're both considered precious metals. We've got the gold-silver spread. Again, precious metals. Now if we look into the currencies are an interesting group in the spread markets. Really, when you're looking at currency spreads, if we take the Swiss franc, for example, okay, and a straight Swiss franc future is, how many dollars does it take to buy 1 Swiss franc? And that's the number that we see. If it's trading at 67, it takes 67 cents to buy 1 Swiss franc. Now, if we do the same thing with the euro, it's how many dollars does it take to buy 1 euro? Looking at the relationship of the Swiss franc to the euro is we're looking at how many dollars to the Swiss franc versus how many dollars to the euro, or really how many euros to the Swiss franc, because they both have the same common denominator, US dollar, in the futures market We are looking at a whole different kind of futures contract.
So with currencies, really what you're doing is you're going through and you're comparing all of the different currencies to what it costs to buy these currencies based on the U.S. dollar index.
Exactly.
So they've got this common denominator throughout the entire list of currencies.
Exactly, and you'll see, for the cash currency traders, the people that actually trade on the Forex, they don't even get cumbered down with having to go Swiss francs to dollars Swiss francs versus dollars to euros. They just get rid of the dollar and just say Swiss francs to euros, and that's what we're doing here too, in 2 transactions instead of in 1 transaction. It can be interesting in there. The currency markets aren't an area of great expertise personally for me. Now we get into another area of just avid spreading is the interest rate markets. We've got the 5-year notes over bonds. We have the 10-year notes over bonds.
In the software, we just call those the financials. It's the financials group.
Right. So we've got that, the 5-year versus the 30-year bond. We have the 10-year versus the 30-year bond. That's called the NOB spread. We've got the municipal bonds or
Which is the MOB spread, right?
Yeah, the MOB spread. It's kind of fitting. It's traded on the Chicago Board of Trade. We have the T-bill versus Eurodollars, or the TED spread. That 5-year versus the bonds. I've heard that referred to as the FOB spread.
Well, I think we ought to call the S&P NASDAQ, I think we should call it the SAPDAQ.
The SAPDAQ. I think the index people deserve to have their spreads named too. I mean, these spreads are so popular that they're actually named. You want to buy the, hey, I'm long the NOB. I am long 10-year notes. I am short 30-year bonds. I'm buying the TED. I bought T-bills. I sold Eurodollars. I'm short the TED. I bought Eurodollars. I sold T-bills.
I'm long the MOB. Gives you a couple of different.
I wouldn't short the MOB. Maybe the spread. Why don't we pop into the software here and take a look at these? I want to start off with kind of the caveat on a lot of these spreads. You get a margin break, and you get a margin break versus double margin, but it's not less than single margin in most cases. So let's just say, for example, we're looking here at a soybeans versus soybean meal spread. Let's say, for example, the margin on soybeans is $1,000 initial, and the margin on soybean meal is $900 initial. We might expect that the margin for this spread it wouldn't be $1,900, but it might be around $1,200 or $1,400. It's more than either the soybeans or the meal, but less than the combo between the two. You'll also see, these margins are therefore, they're high, especially compared to when we were looking at the delivery spreads, or even compared to the, the intermarket or the exchange spreads that we've looked at thus far. But the volatility within this type of spread is much greater as well.
Well, this is more like trading a straight-out futures contract.
It really is. And all the same tools that you use, you can use within this. And you see, if you consider that of if you consider that margin is a reflection of risk, you can see that this spread, these intercommodity spreads could be considered more risky than a straight outright position. I've actually heard it said by many people that spreads give you 2 chances to lose, just as well as 2 chances to win.
Yeah.
And you can see on this one, this moves, and this is a processing spread. There's definitely a relationship between soybeans and soybean meal. And within a processing spread, you'd think that it wouldn't be as big, but look at some of these moves here. Now if we were to go take a look at, why don't we flip over to the commodities tab, and since we're looking from about March to June, mid-June, beginning of March to mid-June, why don't we look at July soybeans during that period? And let's see how big that dollar move was.
About $2,600.
We went from a $2,600 move, and if we looked at that soybean spread, the soybean versus meal spread,
that same range was, well, we looked at probably a range right in this range here, $800.
It is a bit less, but it's still, we're talking substantial moves here. And it makes sense,
especially compared to the ones we were looking at earlier.
Exactly.
When the longer it gives you the ability to stay in them longer, we were saying, because they're less volatile. But these end up being back to almost as volatile as a regular futures contract.
Exactly, as an outright. You'll also see a lot of traders will hedge using this type of thing. They don't want to give up their position going into a report. So they might spread their position, but they're not willing to give up all the potential. So let's say I'm long soybeans going into a crop report. I might look at selling some meal against it, because I'm not willing to go out and sell another delivery month against it. I don't want to take my position off in case it opens 20 cents higher and it's a bullish crop report like I'm thinking. If beans have been out producing, or outpacing the meal, I'll sell the weak sister and buy the strong. Buy the leader, sell the weakest.
This could also be an alternative to backing your position with options. Then you don't have the options premium that's decaying away from you.
Exactly. This isn't the neatest hedge in the world. But it's, a lot of these can, especially to a short-term shock, offer some type of protection for you. Why don't we pop down and why don't we take a look at, maybe let's look at something that really moves here. Let's take a look at the live cattle versus lean hogs. And this is are we barbecuing beef or are we barbecuing pork? You want beef ribs or pork ribs?
Yeah.
And the markets seem to be favoring there in the latter part of the year. They're saying let's throw the beef ribs on the barbie, and not the pork ribs. And the interesting thing here is if we flip over to the commodities part, looking into the latter part, why don't we flip over to a straight commodities chart here, and maybe a live cattle chart. Live cattle was in a strong uptrend as well, and the moves are, from February. If we take a look at that, which we'd already highlighted the size of that move there.
Right around $2,200.
Now let's go back and let's look at that move on the spread basis.
Those are live cattle.
Lean hogs.
Lean hogs. 5,500 or 2,370, depending on where you put your calculator.
Yeah, they're very equivalent moves. It kind of goes to show you that these markets aren't. At times they can be strongly correlated.
Well, and that's why you have the higher, the higher risk, the higher reward. Therefore, you have the higher margins.
Exactly, and I can see if we get rid of a couple of those calculators on the spread, you can see how it behaves, similar to a, just an outright chart. I see a definite basing pattern in there from, mid-November all the way through mid-January. That kind of, sideways channel. And this is almost straight out of, Edwards and McGee or other track and trade videos. You see the upside breakout of the above resistance. You go back, you test the 50%, the halfway point of the trading range, or the 50% retracement level of that trading range.
Then you continue on, and you do the same thing. You have another retracement back to the 50%.
The same basic tools that we use are extremely applicable, to these markets, and maybe even more applicable in that not as many people are looking at this, and they're traded in two separate pits, and you just, maybe you don't have the guys playing the games, as such there that you might see, and you do get a chance for some good strong trends. Maybe why don't we pop down and take a look at a how about a heating oil unleaded gasoline spread. This is an interesting spread, from the vantage point of when do we use a lot of gas?
The summertime driving season.
Exactly.
Except for it's the summertime driving season where we start ramping up for our heating oil. That's the wholesale side of it. They start creating the heating oil during the middle of the summertime. That's a use time for the unleaded, but it's the wholesale use time for the crude.
Right. You have to learn to think ahead of exactly what you're saying there, Lan. You have to learn to think ahead of the basic news. It's not our demand at the pump that tends to drive prices up. It's the guys buying it to fill up the pumps so that we can buy it from them. But
most commodities are based on the wholesale. This is a wholesale market that we're dealing with. This is not as much a retail drive that pushes these numbers around.
Exactly. We don't as individuals make much of a difference. It's the big boys that come in and push it around that makes all the difference. They supply us. We're just buying it secondhand, after a middleman. But if we look at, you think about the heating oil unleaded spread, it makes a lot of sense to be kind of a seasonal spread, and perhaps one that you could look at irregardless of your thought on the direction of petroleum prices. From the vantage point of, as you're getting ready to approach the summer driving season, what do the gasoline jobbers, the middlemen, the distributors, the wholesalers, they have to build their inventory to make sure it's there for when we want to go to the pumps and we start driving to grandma's house or taking the kids on a car trip across the United States to the Grand Canyon and Wally World.
And it's a real trick because they're trying to do the just in time. And so they have to have the inventory ready to go, but they have to have it just in time as well. So there's a real, they work on a real slim margin in there. I mean, you talk about gas stations, you think, gee, many Christmas, I think we should all go out and buy ourselves a gas station and make tons of money because they sell thousands of gallons of fuel every day. But they don't. These guys work on such slim margins. You think about a gas station that sells 1,000 or 2,000 gallons of gas a day, and they're making between 5 and maybe, if they're really lucky, they're making 10 cents a gallon. You're talking about a company, a business that's making maybe $100 a day, $200 a day on their fuel, and they got to operate their entire business, pay employees, pay rent, pay for the overhead, pay their loans off on $100 a day, $200 a day. I know employees who make that kind of money.
Yeah, that's a heck of a way to make a living.
They'll make more money off a Big Gulp soda pop than they will on a tank of gas, because soda pop, as we all know, costs about a penny or two for the, it's more expensive for the paper cup that you put it in than it is for the soda pop. For the little bit of water and sugar that's in there, they'll make more money off their soda pop. So they're trying to draw you in so you go in and buy their soda pop. But we're talking about a just-in-time service when we're talking on a wholesale level, which is billions of gallons of fuel working on slim margins.
Yeah, and if we're going to see a shock to this, this extremely stressed and wound up system, if we're going to see a shock at this time of their building of supply, we're going to see the shock on the unleaded side. If something happens, we're going to see it on unleaded. While if something happens, in the heat of summer, exactly like Lan said, it's when we're all out driving and consuming gasoline. That's when
these guys are starting to ramp up to make their heating fuel.
Exactly. Looking at that, then it's at that point that a stop within something, a monkey wrench is thrown in. It's going to be felt more by heating oil than by unleaded. So it doesn't matter the general direction of petroleum prices. You're betting on the
difference between the price of the two underlying contracts.
Exactly. So like if we look at this one, we actually displayed it as a heating oil, versus unleaded, or long heating oil, short unleaded. So it going down means that the unleaded is gaining relative to the heating oil. And then as we start to think about, summer driving season, and again, like we said, it's the wholesale demand that drives it. This is just another classic example of seeing that bottom in there of, buy the rumor, sell the fact. By the time everybody knows the news, it's not news. I think that's a very easy, that's kind of, to me, one of the real classic intermarket spreads is the heating oil unleaded spread. Another classic intermarket spread to me is, take a look at the gold platinum spread. Now, typically when you look at the gold platinum spread, if we're going to say buy platinum
gold or gold platinum,
we want platinum gold.
Platinum gold. Which one you want to pull up here? You're talking about the
right. I want to pull up actually the way we'd trade it would be an equal dollar. So buying 2 platinum and selling 1 gold. And we'd look at buying 2 platinum and selling 1 gold because the platinum contract calls for 50 troy ounces, while the gold contract calls for delivery of 100 troy ounces.
So that's why we do the buy 2 platinums and sell 1 gold, to try and equal out the quantity sizes there.
Exactly. Now this is we've got to look at this on a equity chart basis. So again, if you remember back from when we calculated spreads, and Track and Trade software does this for us automatically, we're taking the total dollar amount controlled by 2 platinum contracts and subtracting the total dollar amount from of 1 gold contract. Now, real quick in here, just want to kind of say, I think it's 50 times more gold is produced every year than platinum, or platinum is, 50 times more rare than gold. Platinum is also used in catalytic converters. Auto industry is a huge, the single largest consumer of platinum. Now, another thing is platinum also is, the bulk of production comes out of the Ural Mountain region, in Russia or the former Soviet Union. So we've got a lot of political instability there. There's a lot of risk, and platinum is also, becoming more and more in recent years a thin market.
Mm-hmm.
And this used to be an extremely popular spread that markets and very big markets were made in the spread, both in 1 platinum to 1 gold and 2 platinum to 1 gold. You used to be able to trade this spread, and you could almost day trade this spread. It had tight bid offers, and lots of guys made the market in the spread. That's fallen off. But if we go back, and we're going to take a little history lesson here, kind of keying in on the fact that platinum is 50 times more rare than gold, which do you think ought to sell at a higher price?
You would think that obviously platinum would.
Yep, let's look at this spread real quick on a one-to-one basis. Now, as we're looking at it on a one-to-one basis, you'll notice in the, let's go down and look at that bottom down there. Okay, you'll notice down in the bottom part of Gecko where we see the, the last and the where our cursor is and the date. Look at that spread. That's just the straight difference, not the equity difference, but the straight difference.
That's a point difference.
Yep, that's saying that platinum is trading $1.70 per troy ounce over the price of gold.
At 36.30.
Right. Now, if we scroll right around that bottom, remember it's 50 times more rare. So let's scoot that chart back a little bit in time. Keep going back. Where's that spread? I could have scoot that.
That's back as far as it'll go.
Okay, move your cursor around so I can see the spread values. We want to go all the way, see that lowest low back there in March.
Okay.
What was that spread trading at there?
680 to 36.30.
680. I mean, $6.80 over. 50 times more rare. And we can even go back when both of these contracts, now if we go forward in time, when these contracts are liquid. Now typically, it's real common to see gold or platinum trading, somewhere in the ballpark of a $50 to $100 premium. Now if we go back and we look,
we're getting closer. Right in this area here, we're at there's a 25.30 to 36.
Yeah.
There's a 33. There's a 33.30 to 36 at a 1-to-1 ratio.
Yeah. You're really what you're kind of looking at here is you're looking at these two markets that have normally traded at, it's 50 times more rare, and we see them trading at the same price. Whether you're bullish platinum or not, and we can, if we go and look at during that same period, why don't we pull up the April platinum, just a straight April 1997 platinum chart. Let's look at that same period. So we see them starting to trade around the same price, real close, and we'll look at the beginning of January. Okay. So if you started to put this on, because there's a strong seasonal tendency for platinum to gain in value relative to gold at the beginning of the year. Now this makes sense. What is platinum used for? We went over this. It's catalytic converters, right? Mm-hmm. Single largest user. Who's the single largest user of gold worldwide? The jewelry industry. When do the bulk of jewelry sales happen?
Just prior to Christmas.
What happens after Christmas?
Crash. Down it goes.
Yep. I used to have an uncle that owned a jewelry store. And he said that he made probably 60% of his sales for the year during the Christmas shopping season. And he said what I would do is, he said, if I would buy all my inventory going into that, and I cannot afford to underbuy going into that Christmas shopping season, because that customer is going to walk into my store once a year, and if I don't have what they're looking for, they're going to go to my competitor. And I might not get them to walk in next year either. I've got one shot to make that sale. I better have what they're looking for. And you see a lot of jewelry stores operate that way. So there's this big rush of demand to fill and put stuff in the store for Christmas, so you have a big demand for gold, and then after Christmas that demand just disappears.
So, this is for a fun sideline. There's a group out right now who's lobbying Congress to try and get Congress to stop the mining and production of gold. Not that I think it'll ever happen, but they want to stop it because they say that we're using all kinds of chemicals that leach into the ground and destroy the ozone and the natural part of the country in extracting gold, when they say that the majority of the gold stores are just sitting in warehouses doing nothing.
Yeah, and they're I don't know about the majority, but there is an awful lot of gold in storage.
It just sits around.
Yeah. And gold is very rarely consumed. The same gold that, Caesar mined is still around today. It's not like wheat. You don't eat gold. But, so we're looking at, not only do we see a time of the year at this spread where, platinum goes up, and platinum tends to go up because it's used in catalytic converters, and the automobile industry is starting to gear up now at the beginning of the year for the new model year. So they're buying the platinum and get the platinum to make the catalytic converters to put it in the new cars in 6 months, 7 months from then. So platinum is has demand, and then you're looking at right after the Christmas season when gold demand has gone to, heck in a handbasket. You don't even have to be terribly bullish the platinum to see, and then you see this metal that's 50 times more rare than gold trading at the same price. A $6 difference between them. That's a gimme. Had you thought to just trade platinum? We look at the beginning of the year there. Right here in January. Let's look right at the beginning of that year, right in there.
Mm-hmm.
It fell all the way through down into February before that automobile demand kicked in. Are you gonna, maybe you looked at those early Jan lows and you thought they hold. Nope, they broke. Oh, that next low. That low, that's going to hold. Oh, don't know, that one broke too. I'm stopped out. I missed that whole move because I got stopped out. My whole theory was wrong. So maybe you want to short gold, through that, but I'll give you a little hint. Gold went up too. When platinum did, it just didn't go up as fast. But if we go and we look at that gold-platinum spread, or the platinum-gold spread, the 2-to-1, we buy it in the beginning of January.
Looks like we hit it right there, right on.
Yeah, we never took any heat. That spread just went straight up. Now we did see some decent corrections. We saw a little one.
Not for a month and a half later.
Yeah, we saw that little one in the
right
second
in here,
half. Yeah,
right in January, went a little sideways.
How big is that?
Not something you wouldn't have held through. $400. I think you'd have held through that.
$400. I could sit through $400.
Not much more than that, though. I think on a technical basis, you'd have probably wanted to hop out if it had dropped much more. I was going to say, I
didn't even at that number 1 point. What's the date on that number 1 point?
December 16th.
December 16th. Let's look at the 1-to-1 chart for December 16th and see. Our new 1 year lows. What does that spread say? The lower number under the spread. We've got the equity spread.
0.10.
Yep. That 50 times more rare, and it's trading 10 cents over. Then if we go back to the 2-to-1, then we had the 1, 2, 3 bottom. Maybe if you didn't believe, you don't buy. Okay, Scott, I'm not buying this whole thing on catalytic converters versus jewelry demand, and I don't like 1, 2, 3s, and the 50-to-1 more rare I'm not buying. But we put them all in there, and even if you miss all of that, you see the consolidation period in the second half of February, and then the breakout up. Somewhere in there, if you're paying attention, this was a gimme. So I think we beat that one to death, but every once in a while you see opportunities that only exist within the spread markets that you just don't
Otherwise
see
would overlook in the
outrights.
physical.
Exactly. Let's take a look at that. Let's take a look at the knob spread. The notes over bonds. And that's the 10-year T notes versus the 30-year T bonds. And this is commonly considered a proxy spread. This is a very, very heavily traded spread as well. On the Chicago Board of Trade, there are guys that stand around and just make knob markets. Now, do want to kind of preface this with the fact that currently, the U.S. Treasury has stopped issuing 30-year bonds. So this is one that may eventually go away as the demand as the supply of long bonds disappears and we're moving to a 10-year benchmark. But the principle still remains the same, and we might be looking at 5-year notes versus 10-year notes, or fawn spreads. I don't know what we'll call them. Maybe we're going to look at 2-year notes versus 10-year notes, and we'll call them ton spreads. Well, I'm sure the boys will come up with a cute name for it. Not as good as SPASDAC, though.
No, that's SAPDAC.
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 This spread moves. Look at these dollar differences in here. This spread will move. This is also an extremely volatile period for interest rates. If we go and we can take a look at either a 30-year or a 10-year. Why don't we look at just a straight futures chart? Now, look at some of those moves in there. These are several point moves. That are appearing in here. An $11,000 move. A $12,000 move. Almost a $13,000 move.
That's 9,000 right there.
9. Bonds move. Nice stage. Whenever you think of bonds, you tend to think widows and orphans. This is the investment for widows and orphans.
We're looking at a margin here of close to $3,000 initial margin.
Yeah. There are also, you could trade this. You could trade the bonds or the knob spread on the mid-am, which is half-size contracts, and that still moves enough to, interest everybody. Every one tick, the minimum move, and it's just about $16, and it's not uncommon to see full point moves with $500 in a day. See a point and a half, 750, and that's on a half size contract.
Yeah.
That's the mini contracts moving $750 in a day. So if we go back, we're looking at $12,000 moves, $9,000 moves, $11,000 moves. So now if we go back and we look at the spreads, we look at that knob spread. And we see our $3,500 and our $4,200 moves.
They're not so big.
Yeah, it kind of puts it into perspective. The underlying markets are volatile. The spread's going to be volatile.
Right.
Typically
big movers the underlying commodities are big movers, so are the spreads.
Right. Typically a rule of thumb is the knob spread moves between 25 and 35% of the movement of the bonds. You're basically able to get rid of somewhere between 65 and 75% of the volatility in it, which still it leaves you with a lot of volatility. This is a big moving one. We could also take a look at let's look at your SAPDAC. Lan, let's take a look at the S&P 500 versus the NASDAQ 100, or large caps versus small caps. This is your favorite SAPDAX spread. This is one that is, obviously extremely volatile.
And very expensive.
Yeah, and very, very expensive. You're looking at a margin rate of, like $25,000 on the S&P and $18,000 on the NASDAQ future. So we add those up, we would come up with, what, 35, 43, and say maybe we get a break of,
half.
Half. We're still at a $20,000 spread that we're putting on. But if you look at the dollar volume, look at the size of those moves, doesn't look that treacherous, but gee, that little move was what, 17 grand?
$17,000.
That kind of drop in the, end of year, where everybody's out shopping for, cheap values.
There's a $10,000 move there. You're the only one I know that can trade this, Scott.
Yeah, I still say you have a good career as a stand-up comic, Lan. If we, but we have to put this spread into perspective. We're seeing a $10,000 move or an $11,000 move and an 18 grand move. Why don't we go look at the straight S&P futures? Now there are E-minis on both of these as well. But we look at a straight S&P future, and we're seeing 90,000. Yeah, let's look in there. What's that last move in that same period?
Let's get the larger font here. That's a $37,000 move.
Yeah.
$27,000 move.
And that kind of puts our
spread into perspective.
18 grand move into perspective. Now, why don't we take a look in the key real quick for the S&P? I want to say it was about $25,000 margin.
25,005, yeah. Okay. Initial margin, 20,000 maintenance.
So that kind of gives us the ballpark of maybe we say, the spread's going to probably cost us pretty close to that.
Yeah.
Little more maybe even, because it is possible. I can remember several times where the S&P, your big cap stocks would, be up sharply, and you'd see the NASDAQ getting pummeled, during the whole .com blow up.
Most people day trade the S&P and the NASDAQ because of their liquidity. Going with the futures, I mean, if you're into day trading and you're day trading the S&P, you might want to consider holding a longer-term trade with a spread.
Exactly. And if we look at the, let's take a look at a E-mini, just a straight E-mini.
That's not so bad. $5,300 move right there. What's the key say? The key is initial margin. We're at 3,000.
3,000 there versus 17. So say 1.6. We were at roughly 30,000. So 3,000, 5,000. We're looking at maybe a $6,000 margin for the spread or something along those lines.
Mm-hmm.
Just kind of winging it. That's not unheard of. And if you're out there position trading in the stock market and trying to bet on relative performance of large cap versus small cap stocks, that's a reasonable amount. Speaking of stocks with the single stock futures, a lot of spread trading opportunities are available there as well. It's always been referred to within equity circles as pairs trading. It would be along the lines of looking at companies within the same industry group. For example, since I'm sitting here in a software company, we'll talk about computer companies. Who makes a better machine? Dell or Gateway? They both basically have the same business model.
Mm-hmm.
They're both gonna make money when computer sales are well,
yep,
and the economy's strong, and when the economy's weak or we don't have a new hot computer that we all have to have, they're both gonna not make money. When I say suck gas or suck eggs or whatever the term is.
Not make money.
Not make money. But you can bet on one of them is a better company than the other. So instead of saying, okay, well, let's just, since I happen to have a Dell on my desk, I think Dell makes a better product than Gateway. So therefore, if we turn around and we see strong computer sales in the whole 9 yards, then I think Dell will outperform Gateway. They will make more money.
So if you're going to do a spread on those two, you'd want to buy Dell and sell Gateway.
Right, and I'm not making again, to kind of reiterate that point, I'm not making the bet that I think computer sales are going to be strong. I'm making the bet that I think Dell is a better company than Gateway.
Then they'll outperform Gateway.
They will outperform Gateway. So if they both go down, Dell will go down less, and if they both go up, Dell will go up more. It's really, taking that large caps to small caps, Dell to Gateway. It's the same concept as, pork to beef.